Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duc with Tri-City Equity Group. With me is my co-host, Steve Bureaus. Today we have Drew Wahlgren on the show. After 8 years as a risk analyst and passively investing in real estate, Drew left the corporate world and jumped into commercial real estate. He started his journey as an entrepreneur at 21 after earning his BS in finance from CSU Hayward. Today, he enjoys educating investors on alternative investments, specifically net lease real estate. Drew, welcome to the show.
Hey, Duke. Hey, Steve. Thanks for having me.
Yeah, so what led you to entrepreneurship?
Oh, man, it runs in my family, in the blood, I guess you could say. Entrepreneurship, I've had it in a number of different ways. And, first question would be, how much time you got? No, but it goes all the way back. My parents were entrepreneurs. I worked for them. I had my own business at an early age when I was 20 years old and got probably my second degree in business, I would call it, after the college traditional one, and probably learned about 10 times as much owning my own business and then going to college. So yeah, I've always been around it and found ways to hustle and make my own fortune. So for as small and humble as it is, but make my own income in a way that I can control. So I've seen both sides. And as you mentioned, I've worked for corporate America as well. So it's fun to be able to have that experience in both sides. But I prefer entrepreneurship. It's, if you have an appetite for risk, then you'll never turn back.
Yeah, that makes a lot of sense. So can you tell our audience about the fundamentals of sale-leasebacks?
Sure. Yeah, we specialize in net lease, industrial, single tenant properties. But what's more interesting is that part of the strategy, the style of acquisition we make, which is that sale-leaseback. So we primarily are purchasing, this is probably about 80-90% of what we do. We like it. We have a lot of experience here, but we're purchasing a property from an operator, a commercial business who owns the property that they operate out of. So they sell to us and we simultaneously lease it back to them for usually a 15 or 20 year triple net lease. So that tenant is now responsible for taxes, insurance, maintenance, and even capital expenditures. We call it an absolute triple net lease. So in that case, they would be responsible for even roofing, structure, and other capital expenditure items like paving the parking lot. So it creates a really passive type of investment for us as a sponsor, as well as our investors who join us too. There's just no operational risk around managing expenses because now that's on the responsibility of the tenant. Through that sale-leaseback, we're able to have a tenant who's signing a lease at the date of closing and a long-term commitment, 15 or 20 years here. So you've really removed the operational risk around managing expenses with that triple net lease. But you've also removed a lot of that lease renewal risk by having a long runway, 15 or 20 years. And so it gives us a great position to be at, especially if you might be looking to hold a property for 5-6 years. And that cash flow starting from day one. We have this tenant in place. So for us as an investment firm, we love this. There's a high degree of certainty around the cash flow. There's no upside there in the cash flow. I can't manage it better next month and get higher than expected. That's not going to happen. But there's also a very high degree of certainty and protection from the downside here. So we have that 100% occupancy, and you're not going to have, a couple tenants leave and you have to release those properties. So what I would say to characterize it is it's a very predictable cash flow.
So why would a tenant want to take that sale-leaseback deal?
It's a great question. I always kind of laugh about how we're trained up. If you're like you guys and us, everyone in real estate who loves real estate, you picked up the purple Bible, as they call it at some point maybe, and got a penchant for real estate. And you think, well, it's always better to own. And in a commercial business, they have some other, alternative motivations, right? They're going to look at the cost benefits of owning an asset versus accessing the capital that's tied up in the equity of this real estate. So it's not just a real estate play for them. They have a business to run, and they have executive goals that they're trying to reach. The C-suite oftentimes, they're incentivized to hit certain goals. And of course, they're looking around, how can we do that? How can we grow this company and hit these benchmarks that we've set for ourselves? So, accessing capital is a huge one. So you have as a business, there's a lot of different alternative solutions there. I can go to a bank and get long-term debt. With that comes a lot of covenants that can be a little bit restrictive with my business. Hey, I can get $20 million of debt here, but I have to maintain certain financial benchmarks. I can't do X, Y, and Z. It's a little restrictive. On the other hand, I could also get a line of credit. I own this property. Maybe let's just say it's $10 million. That's the value. I can only access about 65, 70% of that with a line of credit. So they look over here at a sale-leaseback and say, look, we're able to access all $10 million here and simultaneously set up a nice predictable lease that it does protect them, right? They can kind of say, look, if there's some major swings in rents, we actually have a very predictable overhead lease rate here that we can really, manage well. And of course, that rent that we're paying is tax deductible. And I should say one other interesting thing is, if you're a CFO of, Joe's Manufacturing and you make whatever doodads, these are types of tenants that we have. But you're looking around and saying, hey, I'm trying to manage our balance sheet. And maybe you're managing that balance sheet to maintain certain benchmarks for some senior debt that you already have on the books. So by taking another loan, you're putting a lot more on your liability side of your balance sheet. So when they do a sale-leaseback, that doesn't add to the liability side of their balance sheet. It doesn't add there. There's cash basically that's become freed up that was tied up in the equity of this property. So it gives them a lot of flexibility. There's a lot of advantages there. And you better believe they don't just look around and go, well, we're going to make a decision in 10 minutes. There's a whole way to calculate the IRR of these different types of ways of accessing capital. So, but as far as motivations for that seller and what they're going to do with the proceeds, it can vary quite a bit. It's pretty interesting for me. I really enjoy this part of what we do is finding out, okay, what are the company's goals? This is our tenant. So we really take a lot of time, weeks, if not months, understanding what the tenant is doing, understanding the risk around this tenant. So it's interesting to see what they're going to do with it, right? What they want to do to, again, meet some initiatives that they've set for themselves, whether it's paying down some debt to give them a springboard to launch into maybe new product lines, or maybe they're at that point where they need capital to invest in equipment to launch a new product line, personnel. Sometimes they're adding it to a war chest to make acquisitions of competitors of theirs. So it could really range, and it's interesting to see how they use the proceeds to grow their company. And as a landlord, we love that, right? You're using the capital, you're using this transaction to strengthen your position as a tenant. And how does that make me feel as a single tenant landlord? I love it. You're going to become a stronger company through this transaction.
Yeah. So speaking of that, how do you conduct credit analysis on your tenants?
Yeah, it's a great question. We have, there's not a lot of commercial investment firms that have a whole credit analysis team, but when you're in the single tenant space, you really need to. And not only that is, we're not talking about national credit tenants generally. You can go get a Walgreens or a Home Depot distribution warehouse or an Amazon even, and it's a really well-known risk around that tenant, right? You have a Moody's or Standard & Poor's credit rating of a AAA minus or plus, and so there's a lot of known there. So you don't have to do a lot of credit analysis there. A lot of it's been done for you by a lot of financial institutions. The space that our sort of sandbox that we play in is with private credit tenants. They're privately held. They're middle market. These don't have a credit rating because they're not doing, $5 billion in revenue. They might be doing anywhere from $50 million to $500 million in revenue each year. And it's a little bit of an unknown around there. So we do a lot of credit analysis. So we have an in-house credit analysis team, really institutional grade people with decades of experience behind them. And again, how much time do we have? But they do quite an in-depth analysis. We're talking about interviews with the whole management team, reviewing as many years back of financials we can get, P&L sheets, balance sheets, looking deeply at everything from what the covenants are around, let's just say they have senior debt on the books. Well, what kind of, dates do they have, maturity dates do they have around there? What kind of covenants are in place? What kind of restrictions do they have from that? Are there private equity groups backing the company? And usually that's a very plus. That's a big plus for us. We like that because there's some deep pockets and really experienced management behind that can help guide the company. And should they have a cash flow crunch temporarily, there are a source of capital there that can support them in a time of need as well. So you can really go deep with it, but I love looking at customer concentrations and really getting deep into the industry they're in. So we act a little bit like a private equity group in that way. We're doing so much work around the tenant and what this business does. However, we don't have that equity risk profile, right? Equity is always going to be subordinate to rent. Rent needs to be paid. And so I've heard it said before, and it's a great way to put it, the risk profile of what we do is really like a corporate bond wrapped in real estate, right? So this is a very top priority for the company. They must pay rent to continue to operate. And so I don't care if this company doubles in size or doesn't. If they stay flat and they don't grow in size at all, as a landlord, that's fine. We're in a great position. We're going to continue to collect rent. They're going to continue to make money. And generally, these are not unprofitable companies. We're talking about doing these deals with companies that have been around for decades. We're working on one right now, about to close it. They've been around for over 150 years, if you can believe that. So some of these tenants have been around for a very long time. They're again using this transaction to grow the company and meet certain initiatives. We're never going to do a deal with a startup Joe Schmo company because there's just too much risk there. So we're trying to find really these opportunities in the seams where you say, look, here's a private credit tenant and there's a perceived level of risk around them because there is some unknown here. And maybe there's even some noise where, hey, they had, maybe they had, 2 years of where they lost money from 2015 to 2017. Okay, why was that? And how can we, as a sponsor, really dig through all the white noise and figure out the story behind that and see if there's something that makes sense, or on the alternative side, see if, hey, there's some inherent weaknesses here and this isn't a deal for us. This is too risky of a tenant for us. But oftentimes there is a really good story around it, and you find that the company has come out of it stronger when maybe there was some struggling years in their past. And so for us as a sponsor, we really want to make sure that we just understand that risk more than anything.
It's super interesting. And yeah, even just hearing your strategy, and I'm even curious about that because it's almost like in some of these instances, I would imagine it's like we're used to, having to go out there and, scour for deals, motivated sellers, that kind of deal, right? Like any kind of typical real estate. For you, it's like, okay, well, it's a solution. And I would imagine in some of these instances, they need what you're bringing to the table because you're, helping them on their liquidity side, right? You're helping to add to their cash balance. And so, I would think you guys have to be, of course, very mindful of like, all right, like, yeah, what is the motivation? What's the driver for you guys seeking out this solution, right? Are they savvy, in that regard to want to seek that out? Because we've run across all kinds of stuff where it's like, no, this is still mom and pop operated, right? They're not quite as sophisticated as we would maybe give them credit for. Or like you said, especially if a business that's been in business for a long time and used to kind of operating a certain way. So yeah, I'm kind of curious, like what types of tenants are you guys typically having for your properties? Like who do you typically see as, and it may vary, I don't know, but.
Yeah, absolutely. It does vary. And what you said is exactly right. You have, generally speaking, a pretty sophisticated management team at these businesses. And so they understand what they're doing, but they also, it's a really nice place to be from a buyer's perspective because they really understand our model and what we need to find yield. And so they really understand that and respect that. And it's still a negotiation, right? They still have to hit certain marks. But the fun part about being on the sale-leaseback is not only negotiating that acquisition price, but also the lease rate and the lease term. So there's certain needs that they may have. And so, in a case where they go, look, we have this initiative to hit, our property's worth $10 million, but we really need $9 million. Right? We don't really need the whole 10. Of course, if it's worth 10, we'd like that. But what can we do here? Maybe I sell this property to MAGCP Partners for $9 million, and the cap rate we keep it the same by lowering the rent. Now this business feels really good about the deal. We feel great about it, right? I'm getting something below market, and I like having my lease rate below market rents as well, because it just gives us a conservative position. Really, if you ever were in a position where you needed to release that property, we want to be well below market so our backs aren't against the wall. So I love that when we can find a way to lower those proceeds and the rents. And then now you have, one metric that our credit team looks at a lot is EBITDA to rent ratio, right? How much money are they making? How many times does that cover their rent obligation, right? So if they're barely covering that rent obligation, it's probably a risky position. It's not one that I would really be apt to pursue. But, hey, we're at 8-10 times our rent in EBITDA, then that's a very strong company. They have a lot of, there's a lot of security for us as a landlord there where, their EBITDAs would have to drop by tenfold in order just to kind of barely be breaking in. So that's a pretty big spread there. But going back to your question about what kind of tenants we're talking about, it can range. Quite a few of them are manufacturers, manufacturing equipment, food production equipment, or even food producers. We have a tenant who makes equipment that mixes and dries granulated spices, sort of large industrial blenders and dryers. Another one that makes frozen pies for Walmart, Sam's Club, a lot of large chains out there, and they have a cold storage element to the property, which we love. There's a huge amount of demand around cold storage. So it could range. There's a deal we're working on right now. It's with a company who makes boilers for steam generation that powers, plants, turbines, utility power plants, all types of things, to another construction firm who has it. We have their headquarters property, and they have about 80 acres because they have a large amount of equipment outside of the building developments for all the equipment they manage, because they build, wind farms for a lot of infrastructure and power generation as well. So there's all kinds of different tenants you have here, but generally we're talking about industrial assets with a mix of office, right? It might be 10% of the asset is office, and sometimes it's 50%, depending on if this might be their headquarters or it's just a largely staffed company. Again, with their headquarters, they have, their accountants, their C-suite, all their other employees who may have offices, a sales team who are housed in the same asset. So it really kind of depends here, but it's really, again, very interesting. I love what we do. We really enjoy it, and digging in and finding out who these tenants are, and you learn a ton, right? I never would have thought I'd know anything about some of these industries, and now I feel like an expert in certain ones of them because I've spent, countless hours researching and reading about what a tenant does and how that services a particular industry. And they're so below the radar, right? If you're anything like me, once in a while you drive past an industrial property and it's a mystery. You just see a building that looks like a cereal box on its side, right? And you're going, okay. And sometimes it's not marked or barely marked. And you go, what's happening there, right? There's 500,000 square feet here. Do you think that, there is a very viable business serving some industry? I have no idea what happens there, but, it's here you have this large asset, and the business has been there for a while, at least I assume, because I see the same kind of trucks coming in and out. And so as, just from the outside looking in, it's a great asset to own. Hey, I have a successful business here who's been operating, again, maybe since 1955, and they continue to grow. If you have a creditworthy tenant, that's a place I'd want to be as a landlord or a passive investor in a deal like that.
Yeah, I mean, something I was thinking about as you're talking too is because like that, you're having to educate yourself on this wide range of businesses, business types, and all your clients are. It got me thinking, like, normally for us, like on the multifamily side, we're focused on one thing, right? We're focused on servicing the resident. We're kind of dealing in one lane of business. Where you guys are having to, educate yourself on, so many different things, manufacturing, or like you mentioned, cold storage, and all these different, it got me thinking about what your typical like hold period would be for some of these, because you're locking these, companies up for these long-term leases. I would be thinking like, okay, on the backside, like, what does this position look like? Would you be attracting the same kind of tenant? It just raises a bunch of other questions just because I don't know the answer. I don't operate in that space. So, what do hold periods look like, for you guys? Like,
Sure. Yeah. So the front end, you're absolutely right. There's a lot of front end work, but again, a very passive investment once you've closed on a deal. So I love that for us. We're able to scale fairly easily because for the other side is the spectrum. If I'm doing a large value add, okay, I got a great deal on this multifamily property and it needs a lot of love. Maybe I'm not even going to do the whole place, but hey, I'm going to renovate 50 of 100 units. The work's just begun as soon as you close. So, and that has its own fun and value add. It's just a different type of deal. I love that as well. I've invested passively with other folks in those kinds of deals, but it's just a different side of where all the work is done, right? So for us, there's sometimes 5-6 months of negotiations and wrapping our heads around what kind of capital expenditure work. We'll still be responsible for the tenant, but how we make sure that there's a plan there, and sometimes even proceeds are set aside for a large roof repair that needs to be done immediately. So ultimately ensuring that it's taken care of, but still out of the pocket of the tenant in that case. So tons of work on the front end. So once we close though, it's very nice. And what that looks like for us as far as the management side is we require in our leases quarterly financial reporting from them. So this is a big way of us mitigating risk. You have a different risk profile here with a single tenant. So we really need to understand where they're at. And I've done a bunch of due diligence, but things can change. So I want to know how things are going with that tenant. And all of a sudden, if revenues have dropped a couple quarters in a row, we're going to have a couple questions. Hey, how are things going? Is this seasonality? Because we haven't seen that in your past revenues. So, clue us in here. So really close relationship we have with the CFOs of these companies, first name basis. We just, hey, Steve, tell us more about how things are going. And, but that's, generally, I'll say that so far we've been really fortunate, and I'll give our credit team a lot of their kudos because we've had some great tenants that, again, are using these proceeds to grow, and we generally see them doing really exciting things. But we want to maintain that open relationship where we know what's going on. So very passive in the case of expense management, but still you want to have keep an eye on how they're doing. And sometimes I'll give you kind of a value add opportunity example, and we see this maybe not very often, 15 to 25% of the time, a tenant says, hey, look, we're doing great, but we're growing. We're outgrowing the space. We love the space. We don't want to move. We have a long-term lease commitment here, but can you help us develop an expansion here, right? I need another 100,000 square feet, and I have this acreage around the property. And of course, the answer is yes. That's a great place for us to be. We've done a lot of development in the past year too. And as soon as you can look at the cost of a development and agree on a cap rate for that lease amendment that makes sense for everyone. And as soon as you're finished, now you have an amendment on your lease. We have increased net operating income by a fair amount there. So really nice to have a value add opportunity, a build to suit expansion there, while still having and maintaining this underlying rent that's being paid month in and month out, right? So it kind of removes a lot of that risk, right? When generally, if I'm doing an apartment property, then hey, I can't collect rent at the place that I have a gutted kitchen in, right? It's just not going to happen. I need to be fairly timely about what you're doing. And you guys know this better than I do about managing that time is probably the biggest risk around some of these value add pieces, because you need to get it stabilized quickly in order to capture that increased rent now. So if I could go back really quick, I just remembered I didn't touch on something that you had asked about, which was the motivation around sale-leasebacks. It's I was going to say earlier that just anyone in real estate, right? You want to be in a place as a buyer working with a motivated seller. So again, I appreciate that part of a sale-leaseback where these aren't people testing the waters just to kind of see. And there's a couple, but generally speaking, we're able to find out fairly quickly that, hey, this is a seller who wants to get the deal done and oftentimes buy a timeline, right? And maybe they have some bridge funding that they use for some kind of expansion or of their business. And they're going, look, we'll get this thing done because we have we got to strike somewhere while the iron's hot. And now we'll come back to our sale leaseback, get this done and sort of pay down this bridge funding or maybe construction debt, whatever it is that they wanted to pay down after the fact. So very motivated sellers and oftentimes have that time element that really gives us a great place to be as a buyer where they're going, look, we'll work with you if you can execute. So having a track record of a lot of sale leasebacks under our belt, being in the space, owning around 250 million of this exact kind of asset currently, sellers and their brokers oftentimes will bring us deals off market and say, hey, Mag Capital Partners, they do this. This is their forte. I've worked with them before. They execute on what they promise. So that's a big piece. They can't screw around with a buyer who goes, oh, I tried, but I couldn't get the financing. There's a lot of that in every asset class where people sort of come in with an offer that, they can't execute on. And as a seller or any selling broker, at least, they know to advise their clients that, hey, if an offer is too good coming in from someone who doesn't really have that experience, you may want to pass. It may sound very appealing. So we get a lot of respect from the sellers in that case. And they say, look, we'd like to strike a deal and we think we can with you. And we understand that, you can execute here because ultimately as a business, we just want to get the transaction done ultimately.
And kind of my last question to you, it's a combination of questions, but a little bit more of kind of future forecasting here. Where do you see kind of the future of this space going? Let's say over the next 5 years, both for the industry and maybe even for you personally, especially kind of as we've come through COVID. I'm sure that's, it's impacted, a lot of different businesses, globally. Where do you see kind of the future of this niche in real estate going and what you guys are working on?
I'll just start with current and kind of go forward. But I mean, as a lot of asset classes have seen, we're right out there with a lot of them as far as cap rate compression over the last 12 to 18 months, probably about 100 basis points in the space that we're in. I know it's more in some other spaces. Of course, you see single family homes just going wild and there's a whole set of reasons behind that. But yeah, even the industrial space, we've been really fortunate to have our concentration here for the last 6 years or so. And, we didn't plan on COVID. Of course, we just said, hey, look, this is a really recession resistant type of asset, with the right tenant. That's more what we were looking at. Hey, at some point, the economy will pull back a bit, correct a bit, cool off a bit. And in this case, COVID happened and industrial just really, got a spotlight on it. And people said, wow, this is a great place to be. You have tenants that are considered critical and essential. So we have no intention of moving away from industrial. We believe in these deals quite a bit. And unless we really find pricing to get so crazy that it doesn't make sense for us, then we'll stay there. But right now, I mean, again, with that compression, I don't think it'll go down another 100 basis points. That would blow my mind. But if it did, we may have to find, some other strategy, to be honest, because we have pulled back expectations for ourselves and for our investors a bit over the last 12 to 18 months as well, and said, hey, we're going to continue on this path of finding these types of tenants who are a very stable tenants, private tenant, but not too risky. We don't want to go again deep into some company who's been turning losses year after year and white knuckle through an asset like that. There's no way. But ultimately, if you want to maintain that level of risk, you have to pull back on your returns expectations with the way pricing is. So all of our investors have been really good. I've talked to other sponsors, and maybe you can speak to this too. But people have been pretty receptive to it. Hey, look, I get it. We're going to be a couple points, back from where we were 12 to 18 months ago. And still have a solid investment. But, hey, maybe instead of X amount, it's going to be, annualized return. It's going to be back maybe 2 percentage points overall. And people have been kind of understanding that as they see the pricing. It's not a secret. But going forward, as far as opportunities, sale-leasebacks are getting more and more popular. So they're getting more popular for sellers, tenants, and it's kind of an education curve. So there's a few brokers out there who do a good job of canvassing. They're on the phone, they're calling businesses. Hey, do you want to talk about this as a solution to grow your company? And again, businesses who have been there for a long time and they've never even thought about selling a property. Again, why would I sell? It's always better to own the asset. So sometimes that conversation is being happening with a broker, and they're bringing kind of educating more businesses, and they start to see the light. And so because of that, sale-leasebacks are becoming more popular. So we're still seeing more of those opportunities. And again, having a track record for us really helps because it gives us a great place to be as a buyer, where we're right up there competing with institutions, Store Capital, Angelo Gordon, some of these large institutional players who are right in that space, and we're right up there with them. So it's it can be a little intimidating because a lot of these guys can just kind of draw a line from a giant fund, a huge portfolio, and put it together. But we've been pretty successful at securing the capital and putting together a solid deal. So going forward, sorry to go back to the question, forward 5 years, I really think, for at least the next 2 years, I don't want to go that far out because who knows, but we're still seeing that opportunity, and we'll really stay in the space. And at some point, interest rates are going to come up a little bit. I don't, at least flatten out. I really don't see pricing going too much crazier than where it is. I don't know if red hot is the right term right now, or white hot. I don't know what you would call it, sizzling hot. But it's pretty intense right now as far as what kind of pricing is out there. So, we've sold probably 6 properties in the last 8 months because of that, because, you have to look at that when you're holding an asset type that's getting a lot of attention.
Yeah, it's a great time to be a seller right now.
Right. So that keeps us busy on the sell side too. And it's, it's even tempting. I start looking around and go, hey, I bought a property a year ago, or I should say we bought a property as a team, and we have a property we bought maybe 12 months ago, and you're still seeing compression in that cap rate since then. And so it's hard not to kind of look at it and really, at least, you don't want to be too structured in a box where you go, no, we have to follow our plan that we initially set. We are open to looking at early dispositions if the price is right. It needs to make sense, and you need to really blow out expectations. But honestly, that's very possible these days. So we'll see how that goes going forward.
All right, let's transition to our fire round. What is the best book that you recommend other than the Purple Bible?
The Purple Bible. I love that. There's a book that I started recently that I'm enjoying. It actually is recommended by our founding principal. It's called Am I Being Too Subtle by Sam Zell. He's kind of a real estate billionaire that a lot of folks know. And the book is, I'm a little bit early into it, but I'm finding it interesting. To be honest, I'm listening to the audiobook. He narrates it. And it's a lot about, looking left when everyone's looking right, zigging when people are zagging, and looking at those opportunities and asking questions. And it really resonates with our strategy. We're going, hey, let's dig in here. A lot of people just see some piece of a deal and kind of immediately sort of pass on to the next thing. And okay, well, why? Let's ask more questions here. And I think Sam Zell really does a great job of that throughout his entire career of going, well, I'm going to dig in here. It doesn't mean I'm committed to it, but I'm going to find out why people, are turning away. And then is there more to that? Is there a bunch of noise here? What kind of story do we have behind this? And let's dig in. So that's something that we kind of can relate to as a firm, and looking into the credit of a company and understanding it deeper than probably anyone else has ever given an opportunity time for.
Yeah, it's definitely an excellent book. What is your superpower?
I think my superpower, this is a little unrelated here, but I think I can cook very well in a very short amount of time. I'd say per minute, I think my quality is top notch. I find that I can whip up a very custom scratch meal and have the whole place cleaned in like 15 minutes tops. That's something, I'm shutting the refrigerator door with my foot while I'm, mixing something over here and have 4 pans going. It's a talent.
It's very useful for time management.
It is. Execute. That's right. All while on a call or something, right? You got your AirPods in, just keep it going. Is that sizzling I hear in the background, Drew? Don't worry about it.
So what is the biggest lesson you've learned over your career?
Oh, that's a great question. I think I've had a number of different, entrepreneurship experiences. And I think really learning to continuously, and I think this kind of comes naturally to a lot of people, and I think there's a little bit of it for myself too, but when you find something that you don't know and not sort of saying, well, I don't know anything about this, so this isn't for me, right? I don't have experience there. Well, everyone starts somewhere. So and obviously there's 24 hours in each day and you can't do everything, but something interests you and you're interested in a business idea or an opportunity. Don't be, intimidated by something like that. And that's sort of advice to myself and anyone else is, just start asking questions, just start reading, just start learning, because you have an interest in it. That's half the battle. The rest is just time. And that's going to be easy when you have a large interest in it. So, I find that kind of the mind shift from entrepreneurs and people who don't tend to lean that direction is sort of finding something that they don't know anything about. And, one person may just say, well, then it's not for me. The other person says, well, I'm going to learn. So that's what I try to get into. And, even from our team, I'm not an expert at everything. I learn a ton just from our credit team, credit analysis. And so I ask a million questions because one day I'd love to have, this many years of 30 years of corporate credit analysis behind me. So is it something that I say, well, that's not my field and I'm not an expert there? No, it's just it's a matter of interest and time and curiosity, and you get there. So it was a convoluted answer, but hope that makes sense.
Yeah, definitely. So for the busy working professional working towards financial freedom, what advice do you have?
I'd really say just continue to invest, on the side as much as you can. I mean, cash flowing investments is something that I've always loved, and I'll never stop investing in. I think it's a lot of fun. You're looking for financial freedom. I mean, everyone's kind of looking for that idea where they just say, well, I had this idea and I transformed it into, 10,000 every month coming in. And that's not generally how it works. So you either have to build a business or use capital to get that financial freedom by seeing cash flow and that multiple sources of income. So I love that. I mean, I've found places, outside of private placements in real estate where you may have a $50,000 minimum, other sources where, hey, I could shovel in $5,000 over here and maybe it's a smaller return, but I shovel that in there and forget about it and watch that passive income go. And you just find any place you can to put that capital and diversify it well and to see those alternative sources of income. And to me, it's like it's a little bit of a game. I enjoy sort of watching that number grow, right? Okay, what can I get to now from a monthly basis? If I put this here, okay, my number will go from X to Z as far as what that monthly income will be. So it's a lot of fun for me. And then, of course, you're taking that, trying to find other opportunities to increase that and just compound from there. So it's a lot of fun to kind of watch your ordinary income and then the sort of side income. And you sort of say, hey, this is this completely passive income stream over here, as if I built another person in my household to go work for me. That's your portfolio, right? So it's fun to see that and grow that. So that's what I would tell everyone is you don't need to throw $1 million aside for passive income to live off of. Just start somewhere.
Excellent advice. So as we wrap up, how can our audience get in touch with you?
Yeah, you can reach out to me at my email, drew@magcp.com, or you can just go to our website and we have a little spot where you can register with us and set up an intro call if you'd like to learn more. It's magcp.com, like Mag Capital Partners, magcp.com. And would love to chat if you're interested in kind of learning more about what we do, and can take it from there.
Awesome. We'll be sure to put that in the show notes. Thank you so much for being on our show.
Awesome. Thanks, Duke. Thanks, Steve.
Wow, what an awesome show with Drew there, Duc, sharing tons of gems and insights with us in regards to a space that we're not, that's not our norm, but this is the beauty about real estate in general is that, there's so many different wonderful facets and so many different ways to be able to optimize and take advantage of, different places in the market space. So Drew sharing with us a lot about his industrial property and how they do triple net lease properties, some different advantages in terms of freeing up capital for these long-term tenants that they have. Some of these businesses he mentioned, had been in business for 150 years. And so you're thinking, okay, why would I be selling a property? But, in reality, that allows them to be able to take advantage effectively of equity that they have in a property that they may already own. at a current, whatever the current, the market will dictate, frees up capital for them to further grow their business. Drew's telling us about the stability of that type of tenant. Again, these are long-term leases that they're signing, typically, 10, 15, 20 years. So long-term, much longer term than we're used to dealing with on the multifamily side. So that's interesting to see kind of that corner of the real estate space there, and how there's opportunity for them to grow within. I shared a little bit about that, about how they can further grow their business, where you don't just have, for us, typically on the multifamily side, we might have a tenant that's, hey, you know what, I'm getting married, or I'm having twins or kids or whatever, and so they grow out of their their individual unit, and maybe we can't accommodate that. Maybe they're going to move on to a single family house or something bigger. Whereas a lot of times he mentioned that they can help them to help their tenant develop out the space that they have. If they're sitting on acreage, hey, maybe there's an opportunity there where they can come into play and help them develop out some more square footage in terms of whatever individual service or product that they're working on. And he said he still seems very bullish and bright on the future of commercial and industrial as a whole. That it's been very resilient, and just as what we've seen on our end. And multifamily as well. So, definitely sees a bright future for commercial and in the industrial space as a whole. But yeah, no, awesome having him on the show. And I know you guys will go back, listen to the episode, see if there's some gems that he can pick up. He definitely shared some great insight at the end of his podcast, just general investing advice and life advice, being not afraid to tackle new skills. If it's something you don't immediately know, don't just say, well, that's not for me. But hey, look, you can dive in, and that's a choice. And so that was something that resonated with me. But yeah, make sure you go back and listen to the episode. Make sure you're sharing that with friends, especially if they're not familiar with that. And yeah, it was great having them on the show.
And if you're interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and more. If you found value in this podcast, please subscribe and give us a review on Apple Podcasts or Spotify. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.
And we're also super excited to share with everyone our upcoming conference. So this is going to be called the Hawaii Millionaire Mindset Conference, which will actually be held here in Hawaii for our listeners that are international or different parts of the country. Great opportunity to come out and take a little business trip and bring the family out. It's entitled The Blueprint. So, come join great top industry leaders for motivation, training, of course, lots of networking. Your net worth is your network. And that is absolutely shown to be true time and time again for me. So that's going to be happening here again next year. So this will be July 21st to the 24th. That will be happening at the Four Seasons here in beautiful Hawaii. We are having early bird specials that are starting even right now. So if you want to check out the site, learn a little bit more about the conference, and get the absolute best pricing that you're going to get on the conference, make sure you go check out millionairesmindsetblueprint.com. Again, that's millionairesmindsetblueprint.com to find out more. All right, guys, we'll see you next time. Aloha. Thanks for joining us.